Announcements of the Q4 FY24 financial results of the listed tech companies is just around the corner, and we are back with our next edition of Analysts Assembly. Today, I have with me Apurva Prasad, Vice President, Institutional Research, HDFC, covering Indian IT services and technology sectors. Thank you, Apurva, for taking time to talk to nasscom, and welcome to this session.
Thanks, Nirmala. Pleasure to be here. Good to see you.
So I'll quickly jump into the questions. Clearly, one thing that is very evident is the uncertain macro environment is, likely to keep budgets under check this year. So, just wanted to understand what are your thoughts on any improvement in the tech spend by enterprises, especially during this quarter? Are there any focus areas in terms of technologies like AI, cloud, security that you see? Any light you can throw on certain verticals, specifically, semiconductor being in the news a lot recently, manufacturing, and also geographies. How is that going to pan out?
Sure. So let me start with the tough one, the macros, which is usually the tough one. I mean, remember, 2023 was expected to be the recession year. As compared to that, we have seen a 3% plus growth in the last quarter in US. So I think budgets overall unlikely to be too different in CY24 as compared to budget growth in CY23. The difference lies in the fact that also post CY23 in the first quarter was impacted by the mini banking crisis. Whereas, if you're looking at CY24, there is expectation now of rate cuts commencing from sometime mid of the year, which could positively impact discretionary spend. And a possibility of a utopian scenario of rate cuts and disinflation and a stable growth scenario. So my sense is that tech spend can improve probably in the second half as the certainty factor goes up. And that's not going to be more linked to the relative weakness of the macros. Because most of these indicators, whether you look at the labor market, all of that is indicating that things are slowing down. Although not much of this would reflect in the fourth quarter. So for fourth quarter specifically, we think that the nature of enterprise spend is unlikely to be any different, which means lower discretionary spend, which means lower conversion from pipeline to revenue. It means there's a lot more scrutiny and prioritization of projects, so much as was the case a couple of quarters back. The positives could be that some of the seasonal furloughs that impacted in the previous quarter, those would be far lower in Q4. Although there are cases of some extended furloughs into Q4, but sequentially, that should be a positive. And the fact that there have been some mega deals and they've been ramping up, so that provides the kind of growth offsets to the leakages, in the renewals. So that's the positive offset. In terms of the second part of your question, yes, I think that AI, cloud, and security will drive a lot of incremental spend. There have been fewer mega deals, though, as compared to the deal bookings that you'd have seen a couple of quarters back. But the nature of that would continue to be around cost optimization. And yeah, I mean, in terms of verticals, you'd see probably BFSI, which is likely to underperform even in this quarter. What you can see is that fact that this has probably never happened, that the gap between tech spend in banks and the growth rate of the BFSI vertical for IT services, that gap has probably been the highest that it's ever been. So while the tech spend by most of the US banks still continue, the growth in the vertical has come off. So I think that's unlikely to change over the next couple of quarters and certainly in Q4.
We also saw verticals like manufacturing doing well in the last quarter, and telecom underperforming. Do you see any shift in that, or will it continue to be the same, especially automobiles and sectors?
Yes, so transportation, manufacturing, yes, that should continue to be fairly strong based on some of the deal announcements that have come through. Telecom is quite interesting. So while there is a lot of stress in the overall vertical, so think of the largest carriers, which are the peak capex cycle is behind, and that should start to come off. So the cost pressures is very significant, and which is why many of them have called out the cost optimization that many of these carriers have to do. What that means is while the end customer is going to face challenges, a lot of contracting is happening in that space. So think of Verizon, Liberty Global, AT&T, and some of these mega deals that have been happening. So while there would be stress, there would be a lot more deal activity in that particular vertical. So that's again unlikely to change. Uh, and yeah, which is why I mean I go back to my previous point. Even in BFSI, there have been pockets of some mega deals. So think of Aviva, for instance, that TCS got. So the nature is going to be very similar to how it was in the past, but some
Right.
of the factors driving it,
Hmm.
could change slightly, maybe more in favor of verticals like healthcare, energy
Okay.
and utilities, where there
Mhm.
could be some kind of an uptick, but some of the larger verticals, such as BFSI, is unlikely to change in the near term.
And any conversations you're hearing related to the semiconductor scenario where investments have been increasing? There's a lot of talk about what is happening there, especially in India. So anything that you are hearing about how that would affect the overall scenario?
Yes, I think that segment has certainly improved as per where it was, a year and a half back or so with the crunch. And of course, with what generative AI has done, I think there is a lot more deals centric around semiconductors. In fact, you see some of the acquisitions that tier ones have done more recently has been around this space. So yeah, a lot more focus on the design side is there, and that's also going to play through in the high tech sub segment in the companies. But yeah, the activity there was also sort of picked up.
Yeah.
What we see is a lot of it is cutting through many of the captives. A lot of this work is coming through captives. So I think that is another way it could play out. So it may not necessarily translate into a material uptick, in the growth rate of companies, but
Mm.
that's also to do with the fact that captives are also on an uptick.
Investing a lot in it. Yes. You talked about deals, and we have seen that you also mentioned large deals and cost takeout deals that have been happening in the last few quarters. So, is this going to continue? And also, where do you see, or when do you see the revival of discretionary or short-term deals coming into play? Is Will that come up in the second half of the year? And also, I wanted to understand if you have any insights around how mid-sized companies are faring in these deals shares. How are they gaining share in these deals? Anything that you can talk about?
Sure. So, Nirmala, I'll take the last part first of that. So, if you see mid tier companies have been outperforming since last 5 to 6 years in terms of growth. So, the outperformance that a mid tier used to do over the tier ones a decade back was very different to what they've done over the last 4 to 5 years. And this is something that we've been calling out for quite some time. Now, it's primarily been driven by the fact that tech buying is moved outside the CTO CIO office, and it's a lot more focused around niche and domain expertise rather than higher weight given to scale in the past. What that's done is that's increased the addressability for a lot of these mid tiers. That's number one. Second, the delivery model changes is also something which is worked favorably for mid tiers, as you've seen that size of deals have become favorable in the point of view that resource allocation relative to the size of deals are sort of better for mid-tier IT companies. And where is this reflected? If you see in the 10 million plus customer count, that large and mid-tier, they give that number, and the growth in that bucket for mid-tier has been significantly ahead of the larger companies. And the final reason would be, I mean, it's a multi-vendor environment in any case. So we've seen improvement in the senior management bandwidth in most of these mid tiers. So that has also been a reason, which has helped. So I think this outperformance, which has become fairly secular for mid tiers, that could continue, although there are more bottom up related factors that are helping them. But this is something that we have said. We see that what mid tiers have done to tier ones in the recent past is something that tier one Indian IT has done to the global larger peers, a decade back or so. So in terms of market share displacement, that's the template that one could look at. And at the same time, a mid tier today is very different from a mid tier, about a decade back or so. And many of them are large pure play companies, in the ER&D side, for example, where they're probably among the most prominent names globally too. So I think, yeah, some of these factors could mean that the growth outperformance for mid tier as an aggregate could very well continue. In terms of your the earlier question on discretionary, two things happening now. Now the first is because there was so much discretionary that was taking place in 2011, early 22. A lot of that which is coming up for renewal is sort of moving out of the pipeline. So which is what I refer to the leakages and renewals. So that's causing that shrinkage. So to speak, and which is to some extent getting offset by the mega deal signings that the companies have had. So I think the trigger point could be rate cuts, and like I said, I mean a possible utopian scenario of disinflation continuing and a stable growth rate, which is what looks like a base case currently. So I think it's going to be more driven around that. In fact, companies that have given guidance for calendar year. And if you look at their guidance for the March quarter and versus that the full year, and if one is to compare the exit rate, it's I think implied that second half should be better based on these factors.
Agreed. And also in terms of the regions, I know we have been tracking that there is this emergence of Europe in the last 5 years. It has emerged as a key growth driver for the industry. So, and also I have seen your recent analysis on the Europe market that you have done a very deep dive analysis. So, can you share some takeaways from there? How do you see that market becoming? Because it's not a core. Our market continues to be USA with over 62% share, but Europe is emerging as a growth driver. So what are some of the highlights from your analysis around that? And will
Absolutely.
it continue? Yeah, will it continue for the next few quarters?
So Nirmala, Europe's pretty interesting. So while you see on one hand there is macro challenge that which is there. I mean, they've grown a lot lower than US. Yet the growth outperformance from that geography for the IT companies is all been very significant. So the growth differential between the Europe revenues and US revenues is again been significantly higher, even if you adjust for the forex and the exchange rates. It's very unusual, and I think a large part which is driving this is more outsourcing / offshoring, which is taking place. And to give you some numbers, I mean, look, the market is about 350 billion odd or so. That's overall IT services there. And if you look at top 8-9 players, including 3-4 large global players, that's at about 70 billion or so. So roughly about 20% of the entire market, right? A big part of last decade, so CY 12-13 to about CY 18, this number was about 13-14%. But over the past 5 years, this number has gone up significantly. And we see a lot of larger IT companies participating a lot more on the public services, government contracts in some of these geographies. Many of them have become leading players there. So I think it's to do with that. It's to do with companies also being acquisitive in that region, investing in that region. But I think that template could be very interesting. The fact that macros have not been supportive, case in point being UK, which has probably suffered the most post-Brexit, yet the growth rate in the recent past in UK geography for most of the companies have been much better than any other parts. So I think even if we are bracing for a scenario that macros slow down, we could still accelerate, on growth as compared to how it played out. So I think Europe template sort of allows us to extend this thesis at least for the next couple of quarters, especially as the scenario is expected to remain pretty much similar. In an environment where discretionary comes back, US could be a bigger contributor to incremental growth rate.
True. And is this also because, traditionally they have been laggards in actually investing in transformational deals and all that Europe. So is that also one of the reasons that now they have started, focusing on that? And any particular verticals that you see this happening where, in terms of BFSI or retail, where is this whole growth coming from, especially from Europe?
Yeah, so I mean, BFSI most certainly. You look at the large platform deals that TCS has been getting, the Aviva deal, or some of the government programs that have been coming through. So BFSI, yes, a big contributor there. There's also manufacturing. Think of the 1 billion plus JLR deal. So I think that there's a lot more contracting which is happening, and there's a lot more activity also towards the GCC side from these companies, and there are many first-time outsourcers too. So it's not just expansion of the larger enterprises, but it's a lot
Yes.
more first time outsourcers. So there's a lot of price benchmarking which they have started doing. That there's a lot of activity around that. There's a lot more penetration into the continental Europe side, which was not the
Mm.
mainstay for most of the companies. So
Yes.
think of the Nordics, the dark region, and there are strategies for each of these particular regions, and that's where most of the companies have invested. So as a market, yes, like I said, the growth opportunity is fairly big. And what we've seen in the recent past is it has grown despite the macros being challenged. In
Yes.
fact, macros being challenged has been a sort of
Driver.
a driver for growth.
Yeah.
Uh, which is a good
True.
thing. I think that's the great thing about the industry. Good times you're in business, bad times you're
True.
also in business.
Also in business. Yeah. True, true. So we also, we have seen in the last few quarters some of the metrics that we track, like your attrition, your utilization, the deal momentum. These were showing improvements, but there are also some of them, like hiring specifically, which has dipped. Client additions have not been so great. The time, period for deal fructification has increased. All these continue to be under stress. Is that how you see it in the coming quarters, or will there be any easing out of these metrics?
Yeah, so Nirmala, I think the hiring situation is quite unique. I don't think there's been in the last 15 years, there probably been only three times that you have seen a headcount reduction, like a quarter on quarter headcount reduction. And we have seen the last 3 to 4 quarters where every quarter has seen a sequential, drop. Partly to do with the fact that you had never seen the kind of hiring that preceded that, and that is across, the industry. But I think it's interesting to note that every time this has happened in the past, the subsequent 12 months have probably, I mean, in hindsight, those have been great times to invest in the sector. So every time there's been a headcount dip, the next 12 months have been phenomenal for the sector. If one is taking a longish call. The other way to look at it, look, attrition has also been down significantly. We've had probably 4 to 5 instances that attrition has bottomed out, in the last 15 years or so. So again, based on how it's played out in the past, from a period where attrition bottoms out, has typically been a good time for investors also to look at the sector. So I think it's to do with the fact that demand came off significantly. So think of high teens growth rate 2 years back, coming down to low teens and flatlining this year.
Yes.
And companies that were doing 30, 40,000 annual fresher addition went up to a lakh or so, and that had to get sort of dialed back. So I think
Streamline.
yes. So I think it's the reduction is a reflection of that. Much lower levels of gross hiring. The fact
Mm.
that many of these efficiencies were not cranked enough is when the
Mm.
focus on utilization and focus on efficiency
Yes.
went back. And think of the
Yeah.
largest cloud providers and the largest enterprise. Over the last year or so, as growth has slowed down, there has been a lot more focus on cost. Which is also not too different with what's happening with the IT companies too. So I think it's there's a lot more cost focus, and if you look at where margins are as a result of these efficiencies,
Efficiencies.
the sector is still below pre-COVID levels, right? So there is
Yeah.
a lead lag factor to adjusting to this. So when the cost of replacement became 40-50% higher, and
Mm.
if that starts to normalize
Yes.
into a scenario where the cost of replacement starts to get lower, there's probably
Mm.
a period of 1.5 year, for that to normalize. The other area where we would have seen that reflected is the subcontracting, which has come off
Yes.
significantly. So there was a lot more dependence during high period of demand, and most of the
Mm.
companies have optimized that. So yes, I think the view is that there is a case that margins could recover from here further based on some of these initiatives around improving cost structure.
And any when you within your conversations with these companies, what is it that they're doing differently to improve these efficiencies, or because that's very clearly getting reflected in their margins, right? Even though the revenue. So, is there anything different that companies are doing to build these efficiencies within the organization?
So the problem that companies are running into is pricing is not a big lever, which was probably the case in an environment where there is crunch of talent. So it is a
Correct.
cost plus model, right? So
Mm.
it's more a function of sort of demand chasing the supply, where there is installed capacity. So a big reason why there is demand is because of the availability of talent pool and
Talent
resources.
pool. Yeah.
Okay, so if you keep that aside, if you look at the typical cost metrics for these companies, for most of the Indian IT companies, a big part of cost is dependent on the onshore wage inflation, which is significantly higher a year back or so. These numbers, which would go up by 1.5%, 2% on an average, were going up by 6 to 7 percentage points.
Yeah.
And that hits your margin, right? And these numbers have moderated because of the economy which
Availability
is
of
cooled
talent.
off.
Yeah. Yes.
Yes,
Yes.
yes. So and that has happened, and you would have noticed what was the level of offshoring versus
Yeah. On site.
onshore.
Yeah. Yeah.
That mix has changed dramatically, right?
Changed.
I mean,
True.
10 to 15 percentage points. So pre-COVID, we were wondering whether offshoring could increase, and suddenly you have 10 to 12% increase in offshoring. And
Yeah.
think of the volume impact of that, because as you
Hmm.
do that, there is a
Hmm.
deflationary impact on revenue.
Hmm.
And despite moving 10% from onshore to offshore, you
Hmm.
had much higher levels of revenue growth. So that tells you how much more incremental volumes came through. So I think the fact that offshoring became a lever across the board, the
Hmm.
fact that there was right role, right price at some point of time, utilization became a bigger focus as
Yeah.
companies sort of went as high as even 88, 89%.
Correct.
Uh,
Correct.
so I think it was a bit of that. It was a bit of location strategy. So
Hmm.
companies getting into tier two, tier three, that to manage their cost structure.
Hmm.
Then a lot of focus on training. And if you just look at the stats around training that the companies have been spending over the last 4 to 5 years,
Yes.
I think that's traditionally been a very strong retention tool, right?
And
So
I guess there's still room for improvement. That's what we read. If you compare with, like you said, we are not even reached the pre-COVID levels in terms of utilizations. And there's still
yeah.
room for improvement there, correct?
There is still there's still room for improvement in utilization, and
Yes,
there's certainly room
utilization,
for
especially.
improvement in
Yes.
utilization. Yes, there is still a lot more efficiency by optimizing the subcontracting pool.
Yeah.
So I think those are still levers. Like I said, we are I mean, look, we are at pre lower than pre-COVID growth average. We are
Hmm.
trending
Hmm.
towards pre-COVID growth average over the next 4 to 6 quarters, and we are right now below pre-COVID margins.
True.
And that typically has some kind of a lag to it.
Yeah.
So it's fair to assume that as that also mean reverts, we are looking like an
Hmm.
upward shift for margins. Now,
Hmm.
within that, there would be company specific factors that could drive that. But
Yeah.
my comments are sort of more across the sector. So you
Like.
could have some companies which could even expand margins by even 200 basis points over the next two
Hmm.
years. But
Hmm.
most of the larger companies, if you see what they have put out statements publicly, is that
Hmm.
they do see expansion even beyond FY24. Some of their cost programs, whether it is the Infosys Project Maximus, the program that HCL Tech is undertaking, I think a lot of these initiatives is to improve margins even beyond FY24.
Yeah, yeah, true. I'll now come to the question which is most talked about right now. Is what are some of the conversations that you are having related to Gen AI? And for example, right now we saw Accenture releasing their results, and they have reported around 1.1 billion from Gen AI projects. I think Accenture is the only company who actually bifurcates the revenue that they want from Gen AI projects. So, have you had any insights or talk to some to understand what are the focus areas of these investments, and are they looking at it differently compared to the other players? And another key thing was, when do you see this happening for our Indian service providers? Because it's evident in all the news that investments are happening across Gen AI projects, but when is that going to translate into proper revenues for specifically for the other players in the Indian sector?
Right. No, I think it's probably the most topical point
Yeah.
across, and arguably the most probably the biggest incremental growth driver over the medium term. And look, companies were already investing in AI. What Gen AI has
Yes.
done is it's really accelerated the spend and made it sort of a boardroom priority. So whether it is building use cases, and you've seen companies have, while they're not disclosing deals around that, it's pretty much still tip of the iceberg. But 100, 200 use cases companies have talked about. There are focus center of excellence that companies are building. There is a lot more reskilling, upskilling happening. So over time, I think it can become more integral to the delivery function, quite naturally, because of the productivity benefits, and because a lot of these contracts are structured to provide that productivity benefit. And if there is a tool which could give you 20-30% productivity benefit, I think that's certainly going to be adopted. Now, whether these new technologies would become general purpose, we have seen some of these technologies, with a fair amount of hype in the past. But I mean, just as cloud was, digital in the past, and now it's de facto, I think this could certainly become bigger. And a good indicator, to assess providers, and this is the investments that they're making on training and reskilling. So while they're not giving out data on bookings yet, so even for Accenture, it's probably just about 3% of their overall deals.
Overall,
that 1 billion. But I think the investments that they're making on training, reskilling, and I think what they do in transforming their internal operations, I think that will be like a good way to assess that. But in any case, look, the big value migration has to happen. Now, GenAI, the biggest sort of beneficiary were the Magnificent Seven over the last year or so, right? I mean, you think of what's done to NVIDIA, Microsoft, so on. And if the value migration from that top seven has to move to the remaining 493 in S&P 500, the role of the IT services companies, I think, goes up that much more. In that process. So I think while the bigger dollars will probably come in as the technology matures, I don't think any company would want to miss the opportunity around this. So it's a bit of a catch-22, but it's something you cannot. I mean, you have to sort of be investing and focused around this. And I do expect companies to start giving out a lot more disclosures over the next few quarters around this. Right now, look, it's more like a company which is having 150 plus POCs. About 5 programs are getting into production. So that's the level of experiment which is leading to projects.
Yeah. No, you're right. So that's why I said, even in our conversations, most of the players are investing in something or the other, again, relate internal or external. But I think that will play out in the next few quarters. We should be able to hear more in details about where that's coming into the revenue stream. Coming to my last question is around the outlook for the industry. So based on the demand scenario and macro environment that we just spoke about, so what is your analysis or prediction for Q2 and especially FY25? Do you see anything happening there? How is it going to change? Again, in terms of specific segments, do you have any color on GCCs? We know GCCs are a different story. I can tell you to that earlier, but you spoke about it. ER&D has been one of our growth drivers for this year, growing at more than any other segments. So, any thoughts around that, especially for the outlook for FY25?
Yes. So look, while I said for the quarter, it'll pretty much be flattish sequentially. And for the year, you're looking at low single digit type of a growth rate. For FY25, we do expect an acceleration of the low single digit growth, about 2 percentage points, move closer to 5 to 6%. Now, a big part of this 5 to 6% is coming in from deals that have already kicked in. And partially it's going to be that base which is going to help. So there is not too much which is built in terms of the environment changing over the next 2 quarters, which also means that Q1 is not expected to be significantly higher, which typically gets much more seasonal benefit. So I think mild acceleration to mid single digit, mid or slightly above mid for FY25, and then FY26 getting on to the long-term averages closer to 8% or so. So that's the trajectory, that we're building in. Having said that, margin expansion or margin recovery is also, what is built into numbers. The fact that most of these companies can improve margins by 50 to 100 basis points. That's currently what you're looking at. So in terms of profit growth, that trajectory is actually improving. So if you just look at the profit growth for the sector, a 2 to 3% profit growth is actually hitting double digit, for the next, so that's probably one of the reasons in anticipation that market caps are doing what it's doing. But to get to the GCC point, look, like we've discussed earlier, I think that's it's certainly getting a lot bigger. And I mean, think of a 50 billion market, growing 8 percentage points faster than the other 150 billion, so I mean, it's eating out of that price. I think Yes, it would depend on how some of these proliferate. So how much of it is going to be, BOT based, how much of it is going to be provider assisted. So there is a lot more opportunity also, which gets created probably for many of the mid tiers. But yeah, I mean, it certainly looks like a risk for some of the large enterprises, with large, who are large accounts, or many of the tier one companies. I think it's going to be a mixed bag. If it's not going to be a very, very binary outcome. But yes, I mean, we do. I mean, you just have to look at the leasing space that GCC is taking, and that'll give you a good assessment of the growth in that segment. But yes, that's certainly going to be a bit of a challenge to growth in the near term, purely because of the growth differential. But over the medium term, look, we have seen enough cases of many of these captives that are also being acquired, or getting rebadged. So it would create opportunities. Over the medium term, I think there'll also be a fair set of opportunities for many of the IT companies. But the growth trajectory should certainly be up. We, however, see that the dispersion will continue to be wide. So in a great year 2 years back, the dispersion of growth between companies was not as wide. They were all growing fairly, close to each other, strong. And then last year, you saw growth dipped. The dispersion was fairly high between the strongest growing and the weakest growing. This dispersion could probably continue even as growth improves slightly. So, which is why I think you would see someone who's probably doing 15-20%, even a mid-sized player, and then there would be somebody who will probably be close to flatline. So I think that dispersion could even continue on to FY25. But yeah, we remain optimistic over the medium term.
Yeah, that's what even our survey when we conducted in Jan, similar kind of scenario that we were. Lastly, now you've been tracking the industry for so long. So what is something, some exciting, something that you're looking forward to specifically, is GenAI something that will change the whole industry, or anything that you have come across which you feel like a thing that has not happened before and could be a game changer for the industry? Just over your thoughts.
Look, I think the beauty of the industry is that you have so much disruption coming every few years with new technologies. The manner in which the industry sort of absorbs all of this and makes it so predictable. I think one has to sort of see how the latest disruption around generative AI plays out, because I mean there is a good enough case that one can make around how much redundancy can be built into the system. There is also so much more net opportunities that can be created. So I think the next few years, as there is going to be better value realization from some of these experiments that are being carried out, and there are going to be bigger dollars that are going to come in. I think the distinction between providers around this technology is something which will be probably front and center. And that'll grab attention. But yeah, I think more importantly, it'll be interesting to see that the rate of market share swing that we have seen Indian IT companies take from some of the global peers, partly to do with the challenges that they have faced. How does that play out over the next few years? And I think that becomes interesting. What also becomes interesting is there are, there's always a set of providers who are more active in the Eastern Europe heritage, and there's a lot more talent focus which has moved into India, which is creating a whole set of dynamics around it, and that could make things interesting too. So that, and of course GCC and what it's doing. So there's a lot of excitement.
A lot of things happening. Yeah. So actually, even though we see growth to be low, but a lot of exciting things that are happening.
Yeah.
Thank you so much, Apurva. It's always a pleasure talking to you. You share such great insights with us. So with that, we come to the end of this session. Do share your feedback with us, and don't forget to subscribe to our YouTube channel and community portal for more such insightful sessions. Thank you so much.
Thank you.